Our current investment property market is actually pretty good if you're buying with cash. Rents have seen double-digit record jumps, and prices have come down double digits as well. So rent yields are actually a lot better compared to before rate hikes. But not many people buy with just cash. Most investors borrow money to buy investment properties, and rising interest rates have been canceling out the benefits of rising rent yields. So for most investors, the rental income numbers don't actually look as great. And then when the general consensus is that Canadian real estate is going to see a historical correction, it just doesn't make a lot of sense to buy right now. But we are seeing very, very early signs that things might be approaching a bottom because bond yields have been dropping, which means the bond market expects interest rates to come down. So in this video, let's take a deeper dive into this. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. Before rate hikes started happening, a 4% cap rate was considered amazing. In case you don't know, the cap rate is your net rent yield that you get on a property by taking your net operating income, calculated as your annual rent minus annual operating expenses, divided by the market value of your property. When mortgage rates were around 1.75%, you'd be cash flowing positive $500 per month at a 4% cap rate. Now, market conditions have changed quite a lot since then. Apartment rents in Toronto have shot up around 10%, and it's very possible to see a 20% discount compared to before in purchase price. So that takes cap rates to over 5.5%, and that's why rent yields look a lot better if you're buying with cash. But if you're buying with borrowed money and you end up using a future-proof interest rate of 5.5% based on another 100 basis point rate hike by the end of this year and another 50 basis points of rate hikes next year, then cash flows are still looking lower than before, still positive, but closer to $100 per month. So right now, one of two things might happen from this point on. The first thing is that prices might still have to adjust down a little bit more lower, which a lot of people are betting on, to take cash flows back to $500 per month. This means prices have to come down another 10% for cash flows to look similar compared to before rate hikes. Or number two, more investors will get used to lower cash flows because they understand that higher rates aren't forever, and they take the view that cash flows will improve when interest rates come down. And if interest rates don't go up as much as expected because of a looming recession, then cash flows will improve sooner than expected. Take a look at this. We saw the US Fed hike rates by 75 basis points last week, but instead of seeing bond yields rise, they actually dropped. In fact, Canada's 5-year bond yields are now down 100 basis points since their peak in mid-June. Here's the thing, even though we do expect central banks to continue hiking rates, it's not actually anything new, and everything has already been priced into the market. The newer news that the market is focusing on these days is more clear signs of a recession. Now, with the latest US GDP data showing 2 consistent quarters of contraction, a recession is looking more and more likely, and so interest rates are coming down because of that. So what does this mean for Toronto real estate investments? Well, we think that we're reaching a point where the market is getting split. There might still be deals, but we're going to see fewer and fewer of these once more people expect interest rates to start stabilizing and then come down. So if you're buying at 10% off today's prices and cash flows look amazing, even at 5.5% interest rates, then cash flows might end up even looking better if actual rates end up being lower than that. And when the general market ends up using lower interest rates for buying decisions, we might end up seeing a quicker turnaround in prices than expected. For example, if the general market starts using a 5-year average variable rate of 4.5%, similar to the recent 100 basis point drop in 5-year bond yields, then prices can actually come up 12% from the price you bought at to keep cash flows the same. It might still be too soon to tell for sure, but we are definitely seeing early signs that a real estate investment property market bottom might be coming soon. And here's my final note, which is that this drop in bond yields is a sign that's specific to investment properties in Toronto. In fact, we're likely going to enter a period of divergence between investment properties in Toronto and end user properties in the rest of Canada. Just remember this. Investment properties do better in higher interest rate environments because rent yields are also rising, and this will continue to balance out the higher rates and keep holding power strong. The 1.75% to 4.5% steep rate hike might actually be manageable for investors, but because end users have to absorb the entire impact of these higher interest rates, end user holding power will be weakened drastically. And as a result, we can expect end user home prices to remain lower for a much longer period of time, even if average 5-year mortgage rates fall by 100 basis points. We're big believers in investing in freehold houses in Toronto, and if you want to chat more about this, we're ready for you. We can look at your requirements and preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.